So this is the SPX Zero DTE Credit Spread Trade Masterclass. So I've been trading Zero DTE for about 2 years, and I think when I started, there wasn't a lot of people trading Zero DTE, but there was one guy in my newly formed group, and I think we had like 30 members at that time. And just as a reference, we have what is it, 14,000? I think 14,000, something like that. But anyway, yeah, Zero DTE was kind of a new thing, and then it just spread like wildfire. So anyway, so with that, just want to make sure you can hear. If you can't hear, make sure you check your settings. But here we go. All right. So what can you expect for today? I'm going to show you how you can make consistent returns monthly based on margin capital at risk using high probability trades, including Zero DTE. And today's workshop here is going to be focused on Zero DTE. Okay, and how to do it without taking large losses and get those returns month after month. Okay, what are you going to learn? How to select the options credit spreads before the market opens, so you've prepared to trade those, and you'll know why you want to prepare before the market opens. How to enter and exit the trade, in what ways, how to prevent large losses, and how to have a general understanding for when not to trade, and how to trade consistently profitable. Okay, so stick with me to the end. We have a special bonus, and I'm going to share that with you towards the end of the time. Okay. And the other part of this is you want to turn off all your distractions. There's a lot of material that I'm going to cover. You will get the replay, and I think you get the actual file, okay, sent to you on the next day. But you may want to take notes. And what I ask is that you save your questions until the end so that we get through the material. Write it down. I promise you that I will answer every question that you have by the end of the session. Okay. All right. So the first thing is, why are you here? And the question is, number one question is, you're interested in learning new strategies that'll take your trading performance to the next level, so you can finally leave that 9-to-5 career behind. It is a dream, and it was a dream that I had for several years, and I arrived. And so if I can do it, you can do it too. Right? So you've seen, heard about, read about others making money trading, and you know how to do it, but you're just not seeing your account grow fast enough to meet your goals. Number 3 is you've tried different trading strategies that you thought, okay, this is it, only to discover that you're just not getting to the place with consistent trading results. And let me turn on the video here. This is a live event, so I want to make sure that you guys can see me here. All right. So I think I covered most of the reasons, but if not, just let me know. And if you can tell me with a show of hands here on the chat, which one represents you the most. It could be 1, 2, or 3, or all 3. And I know for a fact, at one point it was all 3 for me. So is anybody there? Just want to make sure. Yes, all 3. Yep. 1, 2, and 3. Yeah, that's most of the responses that I usually get. So, okay, cool. So let's see if we can conquer this, right? And get you to a place where you're consistent. And that's really my goal with everyone that I work with. I'm a normal guy. This is a pretty brand new picture. On the left hand, me and my wife. We live in Puerto Rico. 4 of my kids are in the middle there. And that's the one on the right is my MBA program with my parents. That was a long time ago. But I'm just a normal guy. Okay, go to the beach, ride bike, kayak. It's a great life here. So I'd encourage you to try it out. All right, so let's set the mindset correctly, okay? Because a lot about trading is setting your mindset and being prepared to do what you need to do when you trade, even if it's something that you don't like to do. And I can tell you a lot of things that I don't like to do in my trading, but it has to be done. So imagine what it would feel like if most of your trades were winners month after month, and it would be confirmed by watching the size of your account grow at the same time. Secondly, is becoming the trader that no longer takes large losses but consistently trades according to a proven trade plan. that is profitable over time, allowing you to grow your account month over month. Now, I can tell you that there are times that I take, a larger loss than what I expect to, and that happens. But what you don't want to do is take a loss that is a devastating loss that puts you back, months into the size of your account, and devastates you psychologically, and it takes you a long time. I went through that. Okay, I went through those stages a couple of times. I've had very monstrous losses in trying to set this up correctly, and trade it correctly. But you don't have to. Okay, I'm gonna talk about a way that you can bypass all the pain and the huge losses and get you to a place where you can trade consistently. Okay, a lot of people are doing it, and you can too. All right, so let's talk about what is a credit spread. Okay, let's talk about the basics of it. Right. So a credit spread is basically two positions. It's a spread, two puts or two calls, where the put or the call that is sold is more expensive than the put or call that is bought. Okay, if you haven't heard that before, try to get your head around this. Okay, so when you actually put on this trade, you are receiving a credit at the time that you put on the trade, right? The risk reward in this trade is horrible, all right? But it's a very high probable trade, and we'll talk about why, right? So let's talk about the construct of it, all right? So this is minus 10 means that it's 10 contracts. Vertical means that it's a spread, right? One on top of the other with the same types of options, either put or a call. SPX 100, that means it's each contract is 100 shares of the SPX. Okay, so it's not the SPX 500. A lot of people gets confused with. It's SPX 100, and if you look at a lot of stocks and when you trade options, it's usually based on a 100 share lot. Okay, the date is the expiration date, 30 October 19. That's a long time ago, and it is 3010. Which is the 3010 is the one that you're selling, and the put and buying the 3005 put. Okay, so the trade is considered a high probability trade. All right, and you don't have to be exactly right about the market direction, and the option premium deterioration works in your favor. Okay, so that makes it a high probability trade. All right, so risk reward, this is important. Okay, the risk reward is very, very bad, and what it is in this case, right, we have 10 contracts, 5 wide, so the max loss would be $5,000 minus the credit received. Okay, and in this trade you would be required to have $5,000 of capital in your account. Okay, and you can trade one contract and it would be $500, right? So that's a very, very minimum that you can use to trade a credit spread. Okay, an SPX credit spread. All right. Okay, again, the max loss is $5,000. So think about it, you're going to get $450 and you're risking $5,000. Okay, the risk reward is horrible. It's just horrible, but that's the way it is. Okay. All right, so let's talk about decay of options and why this is so important. From 68 to 33 days, the rate of decay is 34%. From 33 to 5 days, it's 57%. And from 5 days to expiration, it's 100%. So you're actually trading on the day that it expires. Okay, so all of that premium is going to be gone by the end of the day. So that's obviously the most rapid rate of decay that you can have. And a lot of people like zero DTE because it's, there's no overnight risk. You're in and out. It's a day trade, and we'll talk about having a day trade as well on that. So let's talk about the actual profitability factors in this trade. There are 3. One is the most important one, implied volatility. I can tell you that when the market is at, let's say, 15 volatility on the VIX, the position that you're going to put on is probably going to be less than 20 points away from the market. On the other hand, if you're at a 30 VIX, right, the position could be 100 points away from the market, right? So this is a big factor in trading options. Volatility has a lot to do with it. All right, the profitability factor number 2 is theta. That is the rate of decay for the position that you have. And so theta, a lot of zero DTE traders say, oh, there's no theta in zero DTE, but that's not true. There is theta. There is a rate of change that happens, you know, like I said, it decays completely by the end of the day. All right. So so that's theta, and then the third one is market direction. So if you put on a trade and the market moves away from your position, right? So let's say you were talking about that 30-10, 30,000 or 3,005 position. And that's a put spread, right? It's called a bull spread, and the market moves away from that 3,000. It moves higher. The decay or the rate of change in that premium is going to go down much two right? So keep that in mind. So market direction does have a lot to do with these positions, but so does the other two areas as well, right? So let's talk about risk management, which is the very most important topic, especially trading zero DTE, because you can get in trouble very quickly trading the zero DTE, and you want to make sure that your processes are correct in doing what you have to do. Okay, so first thing is always trade with a plan. The plan should include entry and exit criteria, trade size and composition, and when not to trade. All right. Secondly, determine max loss and risk reward before entering the trade. Third, you want to trade no more than 20% of the credit margin based on the total capital that you have. You got to leave room for drawdowns. You know, not necessarily for zero DTE, but for other credit spreads that you're trading, and you know, for adjusting those positions. Do not allow more than a 2% loss based on your trading capital. So if you are trading with $10,000, your loss should never be greater than $200. Okay, and you can calculate that before you enter the trade. For a highly trending market, position your trades to follow the trend. You know, that's so a lot of times I'll use one-sided positions. You know, when I'm pretty confident where the market's going to go. Obviously, sometimes I'm wrong, and but the trade is forgiving as well. And just yesterday, I had a trade that was, you know, that was just a put spread. The market went up in the morning. I got out of the trade, and in the afternoon, it went down, and it actually breached it would have breached the position if I would have held it. Okay, we'll talk about that in a little bit. Never hold short-term credit spreads overnight. Obviously, zero DTE is not that kind of a trade, but I'm talking about other types of credit spreads. And then size your trades to ensure emotions are not part of the decision-making process. I always tell traders, trade small and trade often. Okay, especially if you've gone through a large loss, you want to go. You know, you want to set back, trade small and trade often. And what happens is, number one, you get the experience by trading often. Number two, when you trade small, the emotions are much less of a factor for you, because you can make decisions to say, okay, I can take that loss. It's only, you know, it's only $40, instead of, man, let me try to hold this position. You know, it's a $400 loss. You know, so you've got to position your trades based on the size of your account and what your emotions can handle. Really, really important. Okay. My pre-market routine includes reviewing the areas of support and resistance, and we'll talk about that a little bit. Reviewing the dollar, because the dollar, when it's going down compared to other currencies, it means that the S&P 500 companies will benefit from that, because their products are cheaper to the rest of the world. Okay, that's just the way it is. Treasury rates, and I'm sure you probably heard a lot about treasury rates going up, you know, and inflation going up, and the Fed not being ahead of the curve. on this, so when treasury rates go up, there's competition for money. Money starts flowing into bonds and out of stocks. That's one way. The other side of this is that a lot of growth companies basically bank on low interest rates so they can fund their growth at a low rate, right? When rates start going up, basically their costs go up and earnings per share goes down, and those stocks go down, before the earnings come out. Review ES futures, because ES is the symbol for the S&P 500 futures, okay? And you want to know where the general trend of the market is going before you get into these trades. Review the VIX level. The VIX is the symbol for the volatility index for the S&P 500. Very important, and I keep that in front of my screen all day long. And then, as I mentioned before, determine the credit spread positions that you're going to save. Save them to whatever platform that you're in so that you're ready to trade immediately. Okay? Post-market, determine if rules were broken and why. Determine if the risk was within acceptable levels, especially for wins. Because if you make a win and you break a rule, that creates complacency. It doesn't matter what you think, it creates complacency. It's in you. We're human, okay? And then you think, that you're going to be able to fix that, and I can tell you that's where large losses happen. Take it from me, from experience. Determine if losses were within acceptable ranges. You don't want to be too small. I do say trade small, but you want to make sure that you're going to be able to take a profit. So you're going to have to risk some, okay? But if you're scared and you have fear, you're probably going to have smaller positions, too small positions, and probably get out too early instead of letting it ride for the right targets. Okay, so this is all part of your trade plan. Should be part of your trade plan so that you have an understanding of how you're going to trade. All right, and then I always look back on my trade plan, and just as an example, my general rule was to roll a trade 7 DTE when I was 20 points away. Well, I've changed that because in higher volatility markets, higher volatility environments, I moved it to 40. And today was a perfect example. I was watching the market go down and down and down, and my rule was I adjust that trade when we breach 40 points. Well, it breached. I almost pulled the trigger on the roll, and the market flashed up immediately. So I was able to hold off. But if it would have breached, I was going to make that trade. There's no decision because the decision's already made before that trade happens. Okay, and so that's the mindset that you need to keep in order to keep you solvent. All right, and upgrade your trade journal with findings. That way it gives you information about yourself and what you're doing, and that way it's a lot easier to correct and be pragmatic about what you're trading. All right, so now let's talk about 0 DTE. Okay, the strategy. Before we talk about that, I want to talk about day trading. Okay, day trading. There's a rule called the pattern day trader. It's the stupidest rule that exists. Okay, because you can get around this thing by trading futures. Trading futures is a day trade. But yet there's a lot better tax treatment on it, and it's great for retail traders. Okay, and you can lose a lot more money. Trading day trading futures than you can on some of the options. So anyway, but the rule is a rule, and you have to abide by it because you will get you can get restricted by it. Okay, so what it is, it's buying and selling and buying the same security on the same day, and not including futures, and that you initiate the trade. And let me see, day trades. You can't have more than 4, right, in a 5 consecutive business day period. So if you go over 4 in 1 week, then you are 4 or more times. Yeah. So basically you can't go, if you hit 4, then you're restricted. All right. Just to be clear. And so, if you're trading 0 DTE and you're closing your position, that's a day trade, right? If you put on a iron condor and you close each leg of the positions at different times, that's 1 day trade. Okay, it's not 2 day trades, 1 day trade. If you leg into a position, you're putting on a call spread and a put spread, and you close that position, that's 2 day trades, right? So anyway, if you're not clear on this, do more research on it so you know exactly when you have a day trade or not. Okay, and it can happen on a roll too, which I got caught, before my account was 25,000. So this is the other part. Your account value, if it's if it's $25,000 or more, you can day trade. Okay, the rule, you'll be tagged as a pattern day trader, but the rule does not disallow you from trading. Okay, once you have $25,000 in your account. But if you're below 25,000, then make sure that you are abiding by the restriction. So what can happen? Basically, you can get restricted for up to 3 months for only selling positions, right? So you want to avoid being flagged for that. All right. Here's a few ways that you can get around it. Limit your trades to 1 a day, 3 days a week. That way you're, but remember, if you're trading both sides, it can be two day trades in 1 day. Okay. So you want to be cognizant of that. Okay. Second is manage your trades from multiple accounts. I know a lot of people who do this. That way you're on one and off of the other, and then on the other one. That way you can prolong the number of trades that you have. You can trade iron condors and let them expire. I don't recommend that, but I know a lot of traders who do, especially that use wider wings. Okay, that way the chances of being breached is lower. However, still you may still have to close the trade and take a loss. All right, or you can trade ES futures spreads, so spreads on futures trades that are not subject to PDT restrictions. And again, who makes up these rules? Doesn't make any sense. But those are the facts. Okay, only the facts. All right. So that's the pattern day trade. So let me share with you how I trade 0 DTE. The entry, I enter 5 to 10 minutes before the market opens. All right. Most of the time. There are times that I wait, especially like on a day today. If today was 0 DTE day, I would have waited a while before I entered the trade just because of the volatility. Didn't know where the market was going. So, but usually I trade. I get into those trades 5 to 10 minute, within 5 to 10 minutes. Okay. Using 5 wide, you need to have a better understanding of the market and just be cognizant of that. You're always going to be closer to the money if you're using the same premium. 15 wide, on the other hand, you can you have more distance from the market, and I'm talking about using the same premium amount. Okay, for each of these trades. Obviously, if you trade a 5 wide and you use 70 cents, and use and trade 15 wide, the deltas are going to be different in those trades. Okay, all right. So the premium that I use is between 35 and 50, and normally I put on 45 to 50, almost all the time, except when I'm adding to a position and I'm confident in the direction of the market, and I have an example of a trade doing that, that I use a higher than 70 cents. All right, and like I said, I have an example of that. For range bound markets, basically 15 to 20 cents to take profit, and for trending market, 10 cents to take profit. Okay, and I almost always take profit. I don't let it expire. Okay. Stop losses. Market moves, immediately against you, and it's really aggressive. You can either get out or stick to your stop loss rules to get out. I use support and resistance, But once it gets to 2x or 3x, the premium, or 3x, 3 times the premium, then I'm going to close that trade, regardless, just because I don't want to take a large loss. Okay. And I do identify support and resistance when I trade, just because I like to know where I have the support or resistance that can save me or get me into trouble. And so I do review that regularly. Okay, got a slide here that got stuck. Let's move on here. Okay, all right. So let's talk about examples. So I'm gonna chronologically go through the trades. A few of the trades that I did this year. Okay, and these are actual trades that I did, and sharing those with you. All right. So the first trade. You can see here at 9:31, I put on a call spread, right, for 45 cents. I had I was pretty confident that the market was going to go down, and so I put it on at that with that, and then I put on also a put spread. Okay, so I put both on right around the same time in that trade. Okay. The market did go down some, and I wasn't comfortable with what was happening, and I went ahead and closed the trade for 60 cents. Okay, so I didn't take a loss, but I also wasn't comfortable in the trade, and so I closed it out. And the reason I wasn't comfortable was because I use other indicators where it shows me the volume of the market trending positions are going, and it was pretty aggressively going down, and so I didn't like the position, and so I went ahead and closed it. Okay, but one thing I wanted to share with you is keep in mind that the position, and I don't see you can. I don't see. Yeah, you can't see my marker there. The position there was the put position was 38.90, 38.80. Okay, and you can see how far it went down. Now, if you would have held on to that trade, you would have taken a pretty good. You would have taken a loss. Depending on what rules you're using. But clearly, we went down very, very quickly, and you probably wouldn't had a lot of time to close out that trade. Okay, so in any case, the if you would have held on, you would have been sweating bullets, because 38.90 is right there, and the market got very, very close to 38.90. But then again, right, it went right back up, and you would have been okay. So a lot of people say, "Oh man, why did you get out of that trade?" Because a lot of times what happens is that it goes down there, but it keeps going down. It keeps going further, and you'll take a huge loss if you don't manage it correctly. Okay, so I was out for a small profit, and I moved on. Okay, I do like getting out of these trades. I try to get out before noon if I can. Just because time is risk. Okay. Second trade, put it on at 9:39. This is one of those cases that I wanted to wait a little bit. I wanted to wait a little bit of time before I before I put on a position. And so what happened was, a lot of times the market, especially if it gaps up, it will retrace. It'll go down during the first few minutes. And this is just from experience, okay, that I have. And so what I did was I put on a second put spread. And again, this is one of those examples that I put it on after, and it was larger than 70 cents, okay? But I looked at where we had a bottom here, and we had a nice green candle up. And again, this is the 5 minute, all right? And I was able to put it on, and because it was a 38.50, 38.40, I was 40 points away from the market. So I felt relatively comfortable And especially when you have the century marks, you know, the 3900. Usually it takes a lot to break those and get through those areas. All right. And for that reason, I was confident that the market was going to have support there. And I put on that trade. And what ended up happening was that I closed it for 15 cents, right on that bar there. Okay. And that was about 11:14 in the morning when I closed it. Okay. All right. Example number, I don't know what number it is, but next example. All right. So obviously this is a very, very strongly trending market. So I put on a put spread, and I didn't know it was going to be trending like this, you know, when it started. Okay. And so I put on the second position, a call spread, right around 9:47. So it was, you know, a little bit further in time, right? And what happened was you know, I felt that the call side was going to continue moving up, so I got out for a loss, you know, for basically a little over 2 times the spread, and then ended up closing the other spread for 10 cents. Okay, so I took a small loss on this one. But remember, you're going to take losses, but you want to keep them small, right? So I took a small loss on this trade overall. All right. And this is why I got out. Okay, so you can see here that the market went up through 35, went, you know, a little bit through 55. But again, you know, if you're holding this position and the market's going up through that, you know, you're going to make irrational decisions and maybe take a big loss at the high there. But again, the market went up and it went right back down. So both of these trades would have been closed basically for nothing. But you just don't know that when you're trading on these. All right. So you want to take that into consideration. So be careful. All right, and this is the final trade, I believe, that I have. Okay, so in this trade, I put on a call spread first, and then second, I put on a put spread, and right around the same, you know, at 9:34 and then 9:38, I put it on, and I was able to close out the call spread at about 9:58. Very, very quick trade because the market went down pretty aggressively there, pretty quickly. And then later on in the afternoon, I was able to close the other leg for 10 cents. Okay, so this is one of those perfect trades that happen, and you know, and it just worked out. And so it doesn't happen all the time, but I wanted to share with you a variety of trades here. I think I have one more, actually. I do. I have one more. Okay. So in this trade, I put on a put spread, you know, at 45 cents, and then I added again another put spread a little bit lower to get in 2 positions. Okay, and at 11:37, I was able to close the position for 15 cents. And I did it just because we had pretty much a range bound market, and I didn't want to get stuck in holding this position for a very long time. All right. So these are the examples, you know, and they happen every day because I trade, well, every other day. I trade 3 times a week, 0 DTE. And so hopefully this helps you and gives you an understanding of what actually can occur on these trades. All right. One more thing that I mentioned yesterday, just yesterday, and that was Monday, May 10th. Okay, I placed a 41.95, 41.85 put spread. All right, I closed it at 11:21. If you look at the chart from yesterday, the market closed at 41.88. Okay, so if I would have left that trade on, it would have breached both positions. And not both positions, but one side of the trade, and would have had just with one contract a $650 loss. You know, and that includes the premium that I made. You know, the credit. Okay. So, this is normally you make, $45, $50 on these trades. It would have been a $650 loss if I would have let it just go on and let it breach. Okay. So this is what could happen. And again, this is a factor of the risk reward on this trade. All right. So hopefully this helps you. All right. Let's talk a little bit about technical analysis. Okay. Very, very straightforward. I like to use very simple. This is from a long time ago, but the image here is really, really good to help you understand what forms the different types of technical indicators and support and resistance areas. Okay, so you can see here that you had a trend line from the 2717 down to 2905. Trend line, basically they say a trend line is 2 points and the third one confirms, right? So this is a pretty solid trend line. And then you have, after that, you have another trend line going down, going down, and it forms a different trend, all right? This is an hourly chart here. You have the support areas. Support, where you can see the market would go down. It stayed there for 3 days, broke through. That support actually becomes resistance, right? And then at the end here, you have a trend line break at the circle here, and that usually identifies a reversal in the market from it going down, breaks a trend line, actually breaks support, and then moves higher. Okay, so it's just a pattern that is created. And if you sit in in front of the screen as long as I do, you get used to seeing these patterns without even drawing the lines. They just appear, and you know which way to trade, and it gives you confidence. Okay, really, really good for futures trades, which is my next webinar, and you don't want to miss that one because just a quick note on futures. If you trade them right, you trade with the trend, you use small positions, you can make a killing on it. All right. And I'm going to show you how to do that in the next webinar. Okay. So, just a little plug for me. You don't want to miss that next webinar because the micro futures are the best thing. I am telling you, and I've traded for almost 30 years. The micro futures are the best thing that has happened to retail traders in I don't even know how long that I can remember. Okay, because you can use very, very small positions and it's leveraged and make a killing. Right. So I started with $3,000 in an account, and I started last year. Okay, and I made money last year, but this year I used Trade of 8. I started with a $3,000 account and basically got it in 4 months up to 15,000. Right. And this is not aggressive trading. I mean, yes, I trade almost every day, but it's just leaving positions here. And these are swing trades, right? So, I'll talk about how to, start with one contract and you add at different times. I mean, it's a great, great trade. But anyway, okay. So another area, another indicator that I use is basically Fibonacci. And Fibonacci naturally, whether it's natural or other traders are using it, these support and resistance areas congest, okay, and they congest and they form basically support and resistance areas, and I'm just going to mark here all these areas of support and resistance, okay, and it's based on where the market pivots, okay, it goes up and down, and where the market pivots. Okay, so you can see there how Fibonacci, and this is just a 5-minute chart. Okay, I use these on the hourlies and the dailies, right? And they tell me where we're going to have congestion, and when it breaks, where there's a breakout. This is probably the best tool, the best indicator that you can use if you're trading, right? Especially for futures. All right. And I do use them for for 0 DTE to identify those areas and for other credit spreads as well. Okay, guys. Thanks. If you have anything you can think of, just email me and I'll answer your questions. All right. All right. Thanks, guys. Have a great day.